gold is stuck in a choppy range with clear resistance around $29.40. What market drivers are keeping the bulls in play, and what hidden risks might traders be overlooking? Find out in this episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Gold has entered a choppy phase after a strong rally since mid-December, struggling to find direction over the past week. While mixed U.S. economic data has added uncertainty, while concerns over tariffs and U.S. debt issues continue to fuel safe haven demand for gold. Despite a clear short-term bullish narrative, potential de-escalation in geopolitical tensions and uncertainty around the actual contribution of the PBOC's gold purchases could weigh on prices. Beyond ongoing tariff updates and developments in Russia-Ukraine relations, today's FOMC minutes may introduce some short-term volatility to gold prices. Looking at the gold against US dollar daily chart, it's evident that the bullish momentum has weakened, with prices largely oscillating between $28.80 and $29.40 over the past week. While upside pressure remains quite strong, the RSI is still in overbought territory. This suggests that after last Friday's pullback, a healthier positioning has actually encouraged renewed buying interest. A breakout above $29.40 would significantly reinforce the uptrend, increasing the likelihood of testing the key $3,000 level. If the phase extends, $28.80 could act as a support level. Well, when discussing the reasons behind gold's rally, many traders, and I believe even those who don't actively trade, would likely cite safe haven demand first. That's been a widely accepted narrative since the start of this year. And one source of risk stems from last week's US economic data, which sent mixed signals. CPI showed signs of heating up while retail sales contracted, leaving the market uncertain about the US economic outlook. In this kind of trading environment, holding gold seems like the safer choice. Meanwhile, risks are also emerging from the White House updates on the reciprocal tariffs. This includes references to countries using VAT system, clearly aimed at the European Union, as well as scrutiny of China's antitrust regulations, particularly targeting major tech firms. There's also talk of potential tariffs on autos, semiconductors, and pharmaceuticals. While these headlines have fueled short-term gold buying, it's worth noting that a presidential memorandum carries more flexibility than an executive order. With the negotiations still months away before the key April deadline, the market sees these trade threats as more bark than bite, limiting panic-driven gold buying and reducing the likelihood of fresh all-time highs. Beyond tariff updates, gold's rally also reflects declining confidence in the US dollar. A particularly notable risk is the US government's plan to revalue its gold reserves based on current market prices, potentially generating, or I would say creating, nearly $700 billion in capital. While some people view this as bullish for the dollar, but I see it quite the opposite. Whether this move is aimed at easing debt repayment pressures or financing sovereign wealth initiatives, a gold revaluation would severely undermine confidence in the dollar and the Federal Reserve's independence, likely triggering significant forex market volatility. So in my view, hedging against this kind of scenario is a strong supporting factor for gold's uptrend. That said, while we've highlighted these bullish drivers linked to risk aversion, price actions also raises questions about whether some risks are being overlooked or at least underpriced. One key factor worth mentioning here is central bank gold purchases. For a long time, China's central bank has been regarded as the biggest buyer in the gold market, increasing its reserves by 16.6% over the past 2 years. Last October, a strong US dollar and a weaker yuan have pushed up China's gold import costs. And normally during this kind of periods of yuan depreciation, we would see a rising premium of Shanghai gold over London gold, just like we did in early 2024. However, this time from October until now, that hasn't really happened. In other words, China's demand doesn't seem to be the main driver behind gold's recent highs. So what's pushing prices up? It could be buying from other emerging market central banks, or perhaps the physical gold shortage we discussed in last week's video. I mean, this doesn't mean gold is a short, but it does suggest that China's buying may not be as influential as the market assumes. At some point, COMEX and London gold prices will likely return to parity, which would act as a medium to long-term headwind for gold as well. As for geopolitical risks, I'm not an expert in this field, but if the US and Russian leaders meet and the Russia-Ukraine conflict shows signs of easing, a reduction in safe haven demand could put pressure on gold prices. So overall, gold remains in a consolidation phase at high levels. Safe haven flows tied to US economic uncertainty, tariff policy updates, and a potential gold reserve revaluation continue to support prices, while clear bearish catalysts remain quite elusive. I see limited chances of a breakout from the current range and lean more towards monitoring the downside risk. And finally, today's FOMC minutes could bring some short-term fluctuations. If the Fed maintains a hawkish tone, gold might face some mild pressure, but again, the likelihood of a major trend shift remains quite low. So yeah, that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming data and events might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!